Welcome to this section on reconciliations and the close journal entries. In the previous lesson, you posted accruals, estimates, and contingencies. Now you have to prove every balance is real and complete. This is the heart of the close, where the numbers on the trial balance are tied back to the documentation that supports them, where every subledger is forced to agree with the general ledger, and where the 16 close journal entries bring the books to their final, reportable state. By the end, you will understand what makes a reconciliation trustworthy and how the controller signs the close off. Let us set out what you should be able to do by the end. First, describe the 6 elements that make a reconciliation complete and trustworthy. Second, reconcile the operational subledgers, such as accounts receivable and accounts payable, back to the general ledger, and explain why a difference is a control failure. Third, reconcile and eliminate intercompany transactions, including the unrealized profit sitting in inventory. Fourth, review the adjusted trial balance and run a flux analysis against budget and prior periods. And finally, understand the 16 close journal entries, grouped by purpose, so you know what each one does and why it matters. Why can no period close until every balance sheet account is reconciled? Because a reconciliation is the foundational internal control that proves the balance sheet is complete and accurate. A proper reconciliation contains 6 things. It starts with the general ledger balance, abbreviated GL, taken from the trial balance. Next comes the supporting schedule or subledger that explains that balance. Then an explanation of every item in the detail, and any reconciling items that are temporary or in transit. Finally, the preparer signs and dates it, and a reviewer signs off independently. Miss any element and you do not have a reconciliation, you have an unsupported number. That separation of preparer and reviewer is what makes it a control. Every balance sheet account falls into a reconciliation category, and each ties to its own source of truth. Cash reconciles to bank statements and petty cash counts. Accounts receivable reconciles to the AR subledger, which in turn agrees to the aging report. Inventory reconciles to the perpetual system and the lower of cost and net realizable value schedules. Prepaids tie to the prepaid schedule. Fixed assets and intangibles tie to their registers. Accounts payable reconciles to the AP subledger and vendor statements. Accrued liabilities tie to roll forward schedules. Deferred revenue to the contract roll forward, debt to amortization schedules, and equity to the statement of stockholders' equity. Each account has a home where the truth lives. A reconciliation that is late or stale is almost as bad as no reconciliation at all. Why? Because the close calendar depends on timing. Reconciliations must be completed within the deadline, typically within 5 business days of period end. A reconciliation that was not updated for the current period is a stale reconciliation, and that is a significant control deficiency, not a minor housekeeping issue. And when a reconciliation reveals an unresolved difference above the materiality threshold, it does not sit in a queue. It is escalated to the controller immediately. It cannot wait for the next close, because by then the financial statements may already be wrong. Subledgers are maintained by operational teams, while the general ledger is the financial record. The subledger to GL reconciliation forces those two worlds to agree. The total of every customer balance in the AR module must equal the AR balance in the GL. The same holds for accounts payable, for inventory by category, and for payroll detail. The fixed asset register and the intangible asset register, abbreviated FAR and IAR, must agree to their GL accounts for gross cost, accumulated depreciation, and net book value. Goodwill is rolled forward by reporting unit. Here is the rule you must remember. A subledger to GL difference that is not resolved before the close is an ICFR failure, meaning a failure of internal control over financial reporting. When you have multiple legal entities, the transactions between them have to be squared up before you can consolidate. The principle is simple. Entity A's receivable from Entity B must equal entity B's payable to entity A if they do not match. You have an intercompany out of balance, and it must be investigated and resolved before close. The common causes are timing differences, where one entity recorded the transaction in a different period, exchange rate differences on cross-currency transactions, abbreviated FX for foreign exchange, and simple missing entries. A clear intercompany policy sets the cutoff date, who initiates the reconciliation, the deadline, and the escalation path when the two sides cannot agree. Once intercompany balances agree, you eliminate them on consolidation so the group does not report transactions with itself. There are 5 types. Intercompany sales and purchases eliminate, removing the internal revenue against the internal cost of goods sold. Abbreviated COGS. Intercompany loans eliminate, the loan payable against the loan receivable, and the related interest goes to. Management fees and shared service charges offset, fee revenue against fee expense. Dividends between consolidated entities are eliminated in full, and the subtle one is intercompany profit in inventory. If entity B has not yet sold the goods bought from entity A, the markup is unrealized profit still sitting in consolidated inventory, and that markup must be eliminated down to cost. The adjusted trial balance is the final listing of every account balance after all closing entries, accruals, and adjustments are posted. It is the source document from which the financial statements are built, so the controller reviews it carefully. What is the controller looking for? Account balances with unexpected signs, such as an asset showing a credit, which may signal an error or a legitimate customer overpayment. Accounts that are zero but should have activity, and clearing accounts that should be zero but are not, because a clearing account must clear to zero every period. Large round number balances without an obvious explanation, and accounts that moved significantly from the prior period with no explanation already on file. Flux analysis, also called analytical review, is the last quality control step before the statements go out. For every significant account, you compare the current balance to 3 things: the prior period to see the month-over-month change and trend, the budget to see the actual versus budget variance, and the prior year for quarterly and annual reporting. Any variance above a threshold, typically 5 to 10%, and above a dollar amount, requires a written explanation from the account owner. This is your last opportunity to find an error before the financial statements are issued, which is exactly why an external auditor will perform this same analytical procedure on your numbers. After the flux analysis is reviewed and every explanation is satisfactory, the controller formally signs off on the close. That signature confirms 4 things at once: that all entries are posted, that all reconciliations are complete, that all variances are explained, and that the trial balance is ready for financial statement preparation. This is not a formality. It is a key control under the Sarbanes-Oxley Act, abbreviated SOX, which means it is one of the controls auditors test directly. The sign-off is the gate. Nothing moves on to statement preparation until the controller has dated and signed it, taking ownership that the close is genuinely complete. The first cluster of close entries handles accruals and revenue timing. The payroll accrual debits salaries and wages expense and credits accrued salaries payable for wages earned through period end but not yet paid. The goods received not invoiced accrual, abbreviated GRNI, debits inventory or expense, and credits an accrued liability at the purchase order price, clearing later when the invoice arrives. Professional fees follow the same pattern. On the revenue side, unbilled AR debits unbilled accounts receivable and credits revenue for work earned but not yet invoiced. Deferred revenue recognition debits deferred revenue and credits revenue as you satisfy the obligation. And the warranty reserve debits warranty expense, computed from sales times your historical claim rate, crediting the reserve. The next cluster covers estimates and tax, the most judgment-intensive entries. The legal contingency accrual applies when a loss is probable and estimable under a SC 450. You debit litigation expense and credit an accrued litigation liability. The allowance for doubtful accounts is updated under the current expected credit losses model, abbreviated SECL. You debit credit loss expense and credit the allowance for the increase in expected losses. For tax, the current portion debits income tax expense current and credits income taxes payable. The deferred portion follows a SC 740. You debit income tax expense deferred and credit the deferred tax liability, or debit the deferred tax asset when a temporary difference reverses. These four entries carry the heaviest estimation risk. The final cluster handles consolidation eliminations and special adjustments. The intercompany sales elimination debits intercompany revenue and credits intercompany COGS. The balance elimination debits intercompany accounts payable and credits intercompany accounts receivable. The profit elimination debits retained earnings and credits inventory, reducing consolidated inventory to cost. For corrections, an immaterial prior period error debits retained earnings against the overstated account, and a retrospective change in accounting principle debits retained earnings for the cumulative effect. Finally, the other comprehensive income reclassification, abbreviated OCI, debits accumulated OCI for the effective cash flow hedge portion and credits the profit and loss line when the hedged item affects earnings. These entries demand the strongest controls. Let us bring it together. A proper reconciliation has 6 elements and is signed by a preparer and an independent reviewer, completed within the close deadline. Subledgers must agree to the general ledger, and an unresolved difference is an ICFR failure, not a rounding nuisance. For multiple entities, intercompany balances must agree before you eliminate them, including the unrealized profit sitting in inventory. The adjusted trial balance review and flux analysis are your last chance to catch errors, and the controller close sign-off is a SOX key control. The 16 close entries then bring the books to their reportable state. Next, you will use this trial balance to prepare the financial statements. Thank you for completing this section on reconciliations and the close journal entries.